With a 4% guaranteed return, why invest into equities and stocks, correct? I know it feels good to always have guarantee. And if stock markets are looking bearish as of right now, getting guaranteed 4% definitely looks like a smart move. However, today I'd like to share with you and convince you also that keeping too much cash is actually not going to help you achieve your long-term goals. If you're curious, continue watching. Hi guys, welcome back. Let's start with the first premise, which is cash is definitely needed for emergency needs. Whether you are a young working adult needing 3 to 6 months of emergency cash or close to retiring needing 12 months or 18 months of emergency cash, that should be separate from today's topic. What I'm focusing on is if you keep too much cash, you're not going to reach your long-term financial goals. This period is very unique. It's a very rare period to be specific. And if you don't know what I'm saying, if you look over here, Singapore's core inflation has actually eased down to 3% only. However, guaranteed products like treasury bills, also known as T-bills, are right now paying 3.7%. Wow, that means also you can get guaranteed interest without any headaches of market volatility and without taking any risk. You can actually beat inflation and grow your money. How unique a situation is. Not just treasury bills. If you look around bank accounts, the best one possibly UOB One account, you would realize that your first 75,000 can yield you an effective 3% per annum with all the flexibility that a banking account offers you. Not just that, if you bump it up to first 100,000 and keep it there, you can get up to 5% per annum effectively. So if you are a retiree, I would still think these are valuable options. Enjoy this period whereby you can actually grow your monies above inflation. But if you're not, then listen on to these two key points. And let's get to the first one, which is cash is guaranteed to lose to inflation in the long term. How conveniently have we forgotten this wisdom, correct? Back in 2009 all the way to 2021, where interest rates in bank accounts were 1 or 2%, back then nobody cared about treasury bills. Think about it. All the messages that we've been seeing over those years, if you keep cash at 1%, your purchasing power is actually dropping every year. Your cash is getting inflated away. In this example, if you have $100 paying you 1% per annum, and if inflation is just 2%, you will actually see a smaller buying power over time. That is also why famous investor Ray Dalio has mentioned that cash is trash. I do understand that Mr. Ray Dalio has flipped his narrative. Let's hear what he has to say.
Cash is trash, is what you used to say.
Yes, cash was negative 1.5%, 2% real rates. Terrible. Now cash is relatively attractive.
And right now, what he's saying is, it's no more cash is trash. Cash is good, but only temporarily. The keyword is temporarily. Don't misunderstand it. Our money system, again, is designed to be a debt system and is naturally inflationary. Governments actually freak out when we see deflation. Deflation, again, is when things get cheaper and your $1 can buy more and more things in future. Economies in deflation cycles tend to shrink and unemployment starts to come in. That is why governments will always lean towards an inflationary money system whereby $1 today buys less tomorrow and that we have to go to work to earn more and more money. Quite simply, our money system will always have more and more money, as you can see in this chart of national debt of US. Total debt has tripled over the last 15 years. And this is actually a fuel to why the rich are always getting richer. Because the rich own assets, like businesses, like stocks, like real estate and land. No one became rich compounding cash, and it's not going to change, unfortunately.
Cash is always a bad investment, and it was sure to go down in value over time. No, I'd much rather own a good business than have cash.
Only the common folks like you and I hold on to cash, whereas they own assets and sometimes they understand how to take loans to own even more assets. That is not going to change, and the sooner you realize this, the sooner you are to understanding how to win this money game. You must also own assets instead of cash. In the long run, investment is about future expected return. Cash throughout history has only protected the nominal value and has always shrunk against inflation. Don't forget that, despite seeing high interest offered to you right now. The second point that you need to take note is when you exit cash, the next time it is likely too late. This is actually quite profound. And think about this. How do we usually make investment decisions, correct? Many of us see 3.7% guaranteed. We jump up, we feel good about it. This is despite previous tranches offering 4.07%, correct? Because why? We have anchoring biases. Throughout this last 10 years, we've been conditioned to think that cash is only going to offer us 1 to 2%. 3.7% now looks super attractive. Previously, you could only get this through REIT investing, through high-yield bonds, etc. etc. That's why 3.7% guaranteed seems impossible to turn down. But what if we flip the discussion a bit? What if you see that equity markets have unexpectedly performed 30% over 2 years? More and more good news came onto the market, things are looking better, and more advertisements are telling you how to grow your wealth through investing because recent students have clocked double digits in terms of returns. Suddenly, 3.7% guaranteed or not looks too little, correct? Maybe it's time to start investing. And the worst part is when this 3.7% drops even further back towards that 2% range. The lure then becomes joining those people who have invested earlier and have raked in that 30% already. Think about this. That is why there's so many stories of people investing at market peaks back in 2021, 2022. So the natural question is, Josh, 30%? Are you crazy? That's not going to happen. Are you so sure about it? Let's look at some history. 1975, interest rates actually dropped from 7.85% to 5.79%. What happened to equity markets, described in S&P 500, is that it jumped not 30%, but 37%. The jump continued all the way to 1976, clocking in a further 23%. That means this 2-year period actually saw a 60% increment. Most savers who have finally given up that saving is a good idea because they have again saw interest rate drop from 7.85% to 5.79% to 4.98%. And they are all having this fear of missing out and setting up their T-bills to join the equity markets. You can imagine also that back then, all the news was reporting that economy is good, it's safe now, the worst is over. And what happens next? People who were entered in 1976 only saw a decline in their stock portfolio in 1977, and imagine they would have been far better staying in safe assets. I chose this period because, quite simply, what we are seeing now in terms of interest is 4-5% already, and that could persist for a long time. This is a period of higher inflation and it's useful to help us answer some questions that we all have, which may include this second question. Josh, I don't think interest rates will drop and I'm very sure about it. Think back again, back in 2020, if you tell someone that you'll get guaranteed 4% interest, that person will tell you that it's a scam or most likely there's hidden risk. You would never in your wildest dream, back in 2020, imagine that the government guaranteed T-bills will provide you 4%. That is how unexpected things can become. And if we couldn't anticipate what would happen now, how sure are we that we know where interest rates are going to be in the next few years? But I don't want to leave that doubt hanging. I want to show you also a period whereby interest rates climbed all the way to 10%, but stock markets actually rallied. Let's pull out the chart again, and if you have been observant, you realize that in 1978, interest rates climbed, and by 1979, the 3-month Treasury bill actually climbed to 10.05%. What happened to the stock market? It actually rallied. And the rally continued all the way to 1980. And that year's performance was 31.74% in the S&P 500. Yes, 2022 markets crashed because interest rates spiked up. That is the most recent event. But don't assume that interest rate going up is 100% equals to a stock market crash, because history has shown that stock markets can survive. And there are many examples of stock markets doing well even when risk-free interest rates were high. That is why I like to bring up Warren Buffett's quote: "We will continue to ignore political and economic forecasts, which are an expensive distraction for many investors and businessmen. Even if Treasury bills fluctuate between 2.8% all the way to 17.4%. Let's round up concluding points. If you are viewing this right now as a retiree, no problem. Hold cash enjoy this period whereby cash is actually growing in value, bringing you above inflation rate of return. Otherwise, if you are young, if you're building up towards retirement, don't forget, your long-term goal is to place your monies in assets that have high future expected rate of return. And the best one is quite possibly equities, as history has always shown. The worst thing that you can do right now is to sell all your equities and go into cash because of the allure of 4% high guaranteed interest. That in itself becomes market timing and a loss of focus on long-term investment goals. Coming up this Saturday on 4th of November, join us at the second round of JOSH TAN Finance Summit. You would hear latest REIT updates, as well as my latest tips on CPF and retirement planning. We had a full house in our last event. I hope to see you there too, and look for links below to purchase your tickets today. Hopefully you resonate with my 2 points presented. Smash the like button as always, and check out this previous video I have on investing despite bear markets. If you haven't seen that, check it out. I think it has nuggets of wisdom also. Without sign up for me, I'll see you there. Take care as always. Goodbye.